So the first thing I said is you need to look for indicators that may cast doubt on the going concern assumption. And guys, you know what we're looking at when we're saying, do we think they can continue in the foreseeable future? You're looking to see if they are going to have customers and staff, and they're going to be able to make a profit, and they've got suppliers. Everything that they need to help their business to continue needs to be there. And where you're starting to see in a scenario that it's pulling away somewhat, that could be an indicator that they may not be able to continue, or that there could be doubt on whether they will be able to continue. So the standard gives you some examples of financial indicators, and they're obvious. So things like a net liability position or net current liability position. So where the liabilities are greater than the assets, or where the current liabilities are greater than the current assets. What do we have in this situation where current liabilities are greater than current assets? We have unable to pay their debts as they fall due. Does that sound like they are in financial problems, or that they will be able to continue? If they can't pay their debts as they fall due, how can they continue? So that's a massive indication that they are potentially not going to be a going concern. But in addition to that, this is reckless trading. Section 22 of the Companies Act. And this then means that there is non-compliance with the Companies Act. And Section 22 specifically says that the registrar can actually request that you cease trading because of reckless trading. So once again, huge concern that you might not actually be able to continue, because you're going to actually be stopped by the registrar. Okay, so not only are you now looking at reckless trading when you see a net liability position, you now have to think of going concern. And so straight away when you see that, make these notes. Risk at the financial statement level, going concern issue, and non-compliance with Companies Act. Okay, if any of the financiers withdraw support, could be a problem. How are they going to be able to get the money they need? If they have operating losses or adverse key ratios, any of your MAC ratios that you are quite comfortable with, and they look negative, there could be an indicator. So you're looking through a scenario. As soon as you see that there is a statement of financial position or statement of comprehensive income, go and look. Do some of these calculations. Look at assets to liabilities. Look at current assets to current liabilities. Look at loss situations. And you can start to put down concerns with going concern. You guys already are quite comfortable with this, guys, because remember, we always, when we see these, make a note that it's a risk at the financial statement level because of the going concern. So it's all those risks that you would initially have picked up in reading through a scenario anyway, that now you are going to write down as an indicator that could cast doubt on the going concern. Operating indicators, if they intend to liquidate. And we said, yeah, when should they not be preparing their financials according to the going concern basis? If there's an intention to liquidate or an intention to cease. Or key managements have either been fired or have resigned, so they've lost key management or customers or suppliers. Because how are they going to get the goods they need to manufacture? Who are they going to sell them to once they've produced? Labor difficulties, so strikes, very relevant to us in South Africa all the time. And then finally, anything else like non-compliance with any of the regulations that they have to, because this could indicate litigations, could indicate penalties, and potentially not being able to pay those. And then once again, if they do have any legal proceedings that would actually arise as a result of non-compliance, again, could they settle those? Could result in them not being able to continue. So those are all the negatives. The first thing I look at. But then we said, you must look at any positives in order to assess it. We can't just be one-sided and be negative. So the positives are what we call mitigating factors. Okay? And here we said, if they have any plans to try and help them with this negative financial indicators, so things like trying to obtain cash flows through disposal of assets. They can sell their assets, some of them they don't need, use that money to be able to continue operating. Or if they're able to reschedule repayments of loans, or obtain additional capital through share issues, then could be a way that they can keep going for a little bit longer. And this is literally just the 12 months that they need to be going longer for. If they have any plans to try and address any of these operating indicators, so they can hire additional staff who have necessary experience to replace key management, or they can replace customers and suppliers, so they're getting new contracts, or at least they have a potential for new contracts. So it just needs to be potential that could help us. Planning, just the plan, doesn't have to be a reality. And then any plans to try and address any of the other kind of factors, like getting legal experts to help with them where there is potential non-compliance. So anything like that could help them to prove that maybe there isn't only a negative consideration about their going concern. And once I've now done the two of them, I can then go and conclude based on the evidence from both of them. Okay, once again, I've given you the paragraph numbers 10 and A3, which literally give you the indicators and then mitigating factors. So when we're looking at question 2, which is examples as to what management can do to improve their financial position and profitability, I've used the exact same paragraph references because I've said here, any of the mitigating factors that we've picked up or noted over here could be ways in which they could improve their financial position and profitability. But then those are what are sitting in the end of A3. But also then you could just think of additional logical to improve their financial status, to improve their operating status, to improve their legal status. And any of those would be sufficient for you to be able to get marks as to how they could get out of their negative situation with regards to being or having a risk about being a going concern. Okay, next we're going to look at substantive procedures you can perform to test the appropriateness of the going concern assumption.